Welcome to the Smarter SMSF podcast, the show where we discuss the latest insights, ideas and strategies with self-managed super funds, all designed to help make smarter decisions and equip you to be at the top of your game. I'm your host, Aaron Dunn. Hi there folks, Aaron Dunn here from Smarter SMSF and welcome to this week's podcast. The release recently by Class of their March 2018 SMSF benchmark report provides us with key insights into a specific industry feature, benchmark data on SMSFs and across its members, along with insights more broadly how we see SMSFs investing in what is Class's over 160,000 funds that they administer through their Class Super software. And today, again, I'm joined by Kevin Bungard, CEO of Class Limited, who's going to be discussing with me this March 2018 report on the fact that we're seeing SMSFs continue to fuel that ETF growth. So thank you again for joining me today, Kevin.
Thanks, Aaron, for having me here.
Pleasure. So the popularity of ETFs is an interesting one here within SMSFs, and it has been prevalent for some time. I think within this report you talk about the fact that you started looking at this a couple of years ago, and with the current insights, these again throw up some very interesting statistics about the growth of the ETF use and its percentage of asset representation across the sector. So can I get you to elaborate a little bit more on what you've found in these March 2018 insights?
Yes, I think the first thing is to say the popularity of the ETFs within the SMSF's investment portfolios is quite high. When they started, I think the SMSFs made up a significant proportion of the early adopters, and ETFs have gained in popularity across the industry, but they've fallen in terms of the percentage of members, the investors they make up in that sort of ETF sector. And a recent report has said it was down to they were making up about a third of the investors, rather than earlier on they were kind of making up half of the investors or more. But what was interesting when we looked at it from an asset perspective, they're actually making up over 50% of the holdings. So although the number of SMSFs investing as a proportion of the overall population is coming down, they're still investing a lot more than the kind of average investor. And I think we've seen that in other sectors as well, like peer-to-peer lending and other markets where SMSFs invest. They tend to put a reasonable amount of money in. So it's interesting to see that it's still making up half of those assets.
So we see, I guess, a maturity as the ETF market has continued to mature. We've seen the number of individual entities and so forth come into the sector, and that I guess has seen a reduction in the number of those in there. But I think from a dollar of value, there's a substantially higher investment balance that we're seeing SMSFs look to invest, as opposed to, again, what are non-SMSF type of investors. I think we're there who hold on average about $70,000 compared to roughly about $170,000 with SMSFs.
That's correct. Yep.
And that could be.
I
was just going to say that could be something that we see. I guess some SMSFs in that instance look at it as a low barrier to entry here, and something in its early phases. And you spoke about the peer-to-peer lending as well, and that again something that SMSFs, those that are more self-directed in many instances as well, may look to see some of these things earlier than what the normal market might look to do.
That's right. I think it takes time for advisors and that portion of the market where to get an advisor to change their strategy to incorporate ETFs into that, and then for that to flow through to those investors will take a period of time. Whereas, as you note, those self-directed investors, if they see something and they think that it looks like a good vehicle for them to use, then they will adopt it. And As you mentioned, it is about that you've got additional investors coming into this ETF market. In terms of the proportion of self-managed super funds that are investing in ETFs, we've seen that from sort of 2011 be about 7% of SMSFs who are investing in ETFs, come up to about 19%. So, you know, over those sort of 7 years, it's grown significantly, and even over the last couple of years, it's continued to grow. So the proportion of the SMSF market that is using ETFs is increasing as well.
Yeah, and long term, I think with SMSFs, we've seen a very heavy weighting towards the Australian equities market. If we think traditionally, we go to our, if we even go to the Comsex that had the, the mum and dad index type of thing, where we had banks and we had Telstra and those sorts of things. But the fact that ETFs, in a very simple and efficient way, deliver exposure into international markets and really broaden the asset base of SMSFs would certainly be one area of appeal as to why we've seen that shift go from around 7% to nearly 1 in 5.
Yeah, spot on. And I think that's in a number of different ways that ETFs can be leveraged in a portfolio. There's obviously a high proportion of cash traditionally in SMSFs as well. And I think, there's potential for, instead of having that money sitting in cash, particularly when it's such a low return, if you can instead move that into an ETF that maybe is international focus in particular and get more of that growth of those other sectors, there's still a good exposure. It's easy to do. I mean, one of the advantages of the ASX and investing in TDs is it's relatively easy for the investor to participate. It's harder to participate in international markets or to participate in emerging markets or other areas. ETFs give you the ability to actually participate in those markets. All you need is all you need is a broker account. So it makes it as easy to invest in some of those other market segments that as it is in Australian stock.
So do you think it is a pure sort of diversification play, or and I know the report talked about international ETFs make up about 54% of the top 20 in here, so is would it be fair to say that diversification is the key thing here, or is it maybe a driver to other things from a potential cost point of view? I get, what are the growth drivers in here that we see from the report that tend to suggest that SMSFs do have some sort of love affair when it comes to these ETFs?
I think you've hit a couple of the key points, and we've talked about the ease of access. If you compare just simply applying for managed funds, which would be one of the traditional vehicles that someone would have used, if you're off platform, actually getting into or out of managed funds can be quite difficult in terms of the paperwork required. Again, ETFs just make that much easier, or any exchange traded product kind of makes that easier for the investor. So as a self-directed investor who's keen to just get on and do something, and having vehicles that are easier to access is a big part of that. The fact that the ETFs provide such a broad range of market access, and as you say, at fee levels, which compared to going to a platform or going to some of the managed fund products are potentially more cost effective. That all plays into it. I think the other thing you're seeing with ETFs is that people kind of use them as, it's probably not the right term, but they kind of use them as gap filler in terms of if you've got an approach to, you've got some stocks that you're investing in, what you've got some stocks you're following closely.
Yep.
But then there'd be, you need more exposure to international, you need more exposure even to the Australian market. Buying into an ETF that's an ASX 200, ASX 300 type product. It's going to give you the rest of that sort of exposure without having to do too much work around researching individual stocks and so forth. So you can have your Telstras and your big banks, and then you might get, but I need a bit more exposure, so maybe I'll grab another product that will give me exposure to a small caps portion of the market, or give me exposure to emerging markets, or wherever you want to go. So rather than you having to research all of these, even in the international, when we look at direct held international, there's a lot of tech stocks that are held directly, or even things like Berkshire Hathaway. So products that are well known, or companies that are well known by investors and well researched. But if they want to get exposure beyond that, without having to do a lot of work around individual research, then ETFs are a great way to get that exposure. And I think people use it, and they might not be, you might be focused on the market at the moment. You might decide, oh, actually, maybe I don't want to, follow those stocks as closely anymore. I can switch money into ETFs, and then maybe later if I've got a view that, mining stocks are back on the move, I actually want to go and pick a few mining stocks. I can go back, pick those, sell down on the ETF. So as I said, you can kind of use the ETFs as a bit of a buffer around your allocation, and kind of move in and out of them relatively easily.
Yeah, so follow the indice as opposed to follow the actual specific stock, and I guess and that's where some, as you mentioned, some trustees might go, well, I do have a couple of favourites. You may have a couple of particular stocks there that you may want to be a little bit more exposed to, but in a general sense, the expertise doesn't necessarily sit with that trustee if they're not an active investor as such. So they may be better, running the indice, whether it is at a S&P level, or whether it's right down to, like you said before, an emerging companies type thing that gives them the exposure that they wouldn't ordinarily get, or they wouldn't ordinarily have the expertise to be able to deliver on. So
and they can change that over time if their level of conviction about what they're doing varies. They can move in and out of those ETFs really easily.
Yeah, and that sort of liquidity, the ability to make it liquid like you do an ordinary share, is certainly something of appeal. So the other thing that I wanted to talk about from this report is you've continued to evolve some of the benchmark data in here, and as we go beyond 1 July 2017, we've almost hit sort of the 1 year anniversary of implementation around the superannuation reforms. We're starting to see a few more insights into things around the membership, account balance, the member phases, and more. So what my question to you here is are there any shifts that you've started to see in the data since the introduction of the reforms from the 1st of July 2017? So we've had 3 reports, sort of post the implementation of it. If we think about average net assets per member phase is something that appears to be new in here, and it talks about this largest component being mixed. I guess I'm interested in getting your thoughts on why you're looking at some of these things, and where we're seeing some of the changes occurring post the reforms.
Yeah, with the benchmark report, we're hoping to provide people insights into what's going on in the industry, and as you note, the super reforms have made a massive change to the mix of self-managed super funds, and probably the 2 big factors there were the transition retirement income streams effectively becoming accumulation phase money now instead of retirement phase money. Yep. And so the 30% that's in accumulation, that's increased by about 5% over the last 12 months. So since the year before. So yep. That's really, we think a lot of that's driven by the change in the status of the transition to retirement income streams. And the other big one, as you noted, the mixed portion is the largest portion of the market now, and that's gone up by about 10%. And that's been driven by those pensions that were over 1.6 mil, basically having to convert money back into accumulation phase. And so you saw a big decline in the number of funds that were in pure pension phase. So that's fallen dramatically.
Yeah, okay. So that'll be, I guess, really interesting to follow over the coming reports into the future years, because in some of the past conversations that we've had and through the benchmark report, we've spoken about the ways in which members will be taking benefits out of superannuation. So we'll be watching with great interest to see how some of this data unfolds. And I think it's a credit to the class and or the team there in putting this stuff together, because it really gives us some fantastic insights into the way in which the dynamics of the sector are unfolding. We've of course seen the statistical report from the ATO give us data historically, but it's really a snapshot at a particular point in time. But when we think about the ability to be able to see a fluid piece of data and a growing piece of data, that continuing to provide insights, it's helping not only at a fund level be able to make decisions, and at a practice level to make decisions, but then also, I guess, right across industry. If we think about reports that are being generated at the moment from a productivity commission point of view, we go things right through to Royal Commission, be able to have data that we can hold, hang our hats on going forward, I think is going to be critically important. So, again, I think you should be highly commended for the work that gets done in this every quarter. So, if I can say in respect to that, where can people find out more about getting access to this report and of course, subscribing to receive these when they get released each and every quarter?
So you can go to the class website, so class.com.au, and if you go to the Insights page on there, then you can download those. So, and you can download all of the past reports as well. And I might just add to that as well, Aaron, that I think it's important from a policy point of view, with the Labor Party talking about their upcoming policy. When we get the data, so the next report, we will look at this pension phase data in particular, because we'll have, I think, then a final picture post-lodgement of where these funds have all settled to. And I think we'll look at the amount of money that's moved from being in that tax-free pension phase to moved back into accumulation phase is significant. So in terms of policy settings, the sovereign super funds are already going to be paying a lot more tax than they were paying before because of this shift. So we'll look at some of that going forward as well.
Yeah, I think, and that's a critically important thing. When we, the data from my understanding was, reflective of about the 2014-15 year, which quite clearly, when we look at what Labor's policy is around the, abolition of the franking credit refund, doesn't reflect really the expectation of revenue to what they may actually get. And then you overlay that with the fact that, we've seen the coalition government look to now increase from 4 to 6. I think very, very quickly we will see some of those members with larger credits look to build out additional membership to see the benefit of those franking credits not get lost into the coffers in Canberra, but rather within the contributions tax within the family group. So, and I guess the last thing, Kevin, we have upcoming in September, the Class Connect conference. Do you want to give that a little bit of a plug in terms of what those that may wish to attend would be looking to get out of that particular conference?
We're looking forward to actually having a conference where we'll be talking about something other than the super reforms, but essentially what we'll be talking about is what the world looks like in a post-reform. What things should we be worrying about next? And I think it'll be nice for everyone to be thinking about what they should be doing in terms of their practice, areas that maybe are a little still undeveloped in the industry, like estate planning and so forth, but also some of the residual strategies and so forth that result from the impact of super reform and what people need to be doing going forward. But I think yourself and others, I'm sure, are thinking about what the world looks like for practices moving forward and how they grow practices and adopt to the best practice based on what the industry needs going forward.
Yeah, absolutely. And so in terms of access and registration for that, they can go to the class website, I presume, to find out more about the Class Connect conference?
They can. The early bird is closing real soon now, so I'm not sure.
So get your skates on, is the short answer. Yeah,
exactly. So get online and have a look and sign up for that. But some terrific content and some terrific speakers there.
Yep, including myself. So I very much look forward to it. And I think, as you rightly said there, Kevin, it is not just about understanding the technical of what's happening into the future, but really, a lot of it is practice design, and looking at the way in which, practices need to continue to evolve and understand where the industry is heading. And this data is just one piece that helps us as professionals to understand where the future of SMSF lies. And that's a lot of the work that I enjoy doing and get a lot out of sharing with others as well. And one of the reasons why I do the podcast. So to you again, thank you for taking the time out of your busy schedule. It is always appreciated.
Terrific. Thank you, Aaron.
Yes, and once again, thank you everyone for joining me in this week's SMSF podcast. I look forward to you joining me next week. Take care and bye for now. Thanks for joining me today on the Smarter SMSF podcast. That was a smart move. If you'd like to find out more about today's topic, you can add a comment either at our website, smartersmsf.com, via our Facebook page, or using our Twitter handle @SmarterSMSF.